Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Matt Wiener, managing director of M&A and transaction solutions at Aon, to discuss the state of the US M&A space and why there is an intensified focus on high quality assets and what sectors are seeing increased activity. It is great to see you. Welcome back to Trade Talks, Matt.
Yeah, great to see you, Jill.
What trends are we currently seeing as it relates to the M&A space?
So as you mentioned, there's definitely an intensified focus on high quality assets. We're routinely seeing, parties that are going into transactions and looking to try to find businesses or targets that are a good fit for their portfolio. We've also seen renewed interest in alternative transaction structures. So if you look at last year, there was a lot of the traditional change of control buy-side M&A that took place. This year, we've seen, just due to some of the M&A headwinds that we'll talk about, we've seen a renewed focus on transactions like minority investments, preferred equity investments, and for private equity sponsors looking to create liquidity for their limited partners, we've seen a renewed focus on secondary transactions. The other interesting trend that we're continuing to see is just new financing arrangements. So as access to debt capitals become more challenging, we've seen things like the private credit markets come into place, and we've seen a lot of clients looking to procure unique financing arrangements for their deals.
With the downtrend that we've seen over the past year and continuing into 2023, what are some of the unique drivers for this downtrend?
Sure. So I think, there's been headwinds from COVID and from things that are happening overseas, like in Ukraine and Russia. But here in the U.S., I think, so the biggest drivers for the downward pressure on M&A have been the rising interest rate environment that we're in, along with the associated inflation. Also, access to capital has just become more challenging. We've seen firms looking to engage in M&A. Certainly, there's been a lot of dry powder available to private equity sponsors who have done capital raising over the last few years. But the ability to access debt financing has been more challenging. And so that has led a lot of parties to not be able to consummate their deals. And then lastly, I would say there's just a large valuation disparity right now. Right. Last year, it felt like a seller's market, and you saw buyers paying really lofty valuations. Now they're being a bit more conservative, and so the bid-ask spread continues to widen. And I think we have a lot of sellers out there who don't necessarily need to monetize those assets and are willing to wait until perhaps valuations come back to something that's more appreciable for them.
But don't you think in a way it could be a good thing that valuations are coming back to reality? I mean, if we've learned anything in 2022, it certainly is about risk management and not being over-levered. I mean, we're living through this, right now in the digital asset space. So perhaps that valuation coming back down to earth could be a good thing.
I totally agree. I think that, again, last year felt really unique in the world of M&A just with the amount of volume that was out there. And we really saw transaction timing being truncated. Normally deals that would take 1 to 2 months to complete were being done in 2 to 4 weeks. And so I think that there was just this kind of tailwind from 2020 where a lot of firms were not able to do M&A, and they came into 2021 looking to deploy that capital, and it created this market where sellers were able to achieve much higher valuations. So I agree with you. I think certainly in our firm, where we focus on risk mitigation, seeing those valuations come down to what seem like more reasonable levels is certainly beneficial for our clients.
What sectors are you seeing increased activity in?
So I would say overall, we've seen most sectors have somewhat of a downward adjustment compared to last year. But healthcare is probably slightly up from what we saw last year on healthcare transactions, and then probably not surprisingly, energy and infrastructure has increased over last year. In traditional oil and gas, due to commodity prices rising, that certainly led to an increase in transactions in the traditional oil and gas space. And then renewable energy continues to be a space where we see a lot of capital coming in. We've had the current administration passing legislation to help promote the creation of new infrastructure. And so that's led to a big uptick in M&A in the renewable energy space.
Right. What are some of the bespoke risks that certain sectors face?
Yeah, so I think, with our clients, they are focused on, preserving liquidity. They're focused on shoring up their balance sheets. And so when they're doing M&A, they're thinking about ways to not have to reserve for certain liabilities. And so in our world, we see a lot of M&A insurance being deployed to help mitigate those risks and to really help effectuate these risk transfer strategies that our clients are looking at. So we've seen a lot of market entrants come in, which has enabled transactions from the small side, call it a $10 million enterprise value, really up to multi-billion-dollar transactions being able to be insured. And then we've also seen clients looking to really try and deal with risk mitigation on known issues. And so the areas that we continue to see growth in are around tax issues, right? So in renewable energy, you may have tax equity investors who are looking to ensure that they're going to get the pass-through treatment that they're looking for, or it could be something like litigation. We've actually seen a big uptick in clients saying, we know this target has litigation or some type of known contingent liability. We'd like to be able to transfer that away from the parties and onto the balance sheet of an insurance carrier. So those are the areas that we continue to see these risk mitigation strategies being deployed.
And as we look into 2023, do you think we're going to see a little bit of an uptick from 2022? Is this really predicated on the, the infrastructure and the inflationary concerns that we have?
Yeah, I think we're going to be a little flat. Probably for the first quarter, just based on what we're hearing from our clients and the advisors that we work with. There's nothing that anyone is telling us in the next 3 to 4 months is going to change dramatically that's going to lead to a surge in M&A. I think what's more likely is once we have a better sense of where the Fed's going to land on rising interest rates, and we see parties saying, okay, we've had kind of a slower 6 months, we're now ready to transact. I think we're expecting the second half of next year to be busier with respect to M&A.
Do you think we'll see a 2020 or a 2021 again? I mean, certainly we see these cycles every 10, 15 years where you get this exuberance that's in the market. And I think regardless of the pandemic pent-up demand, that things prior to then, even in 2018 and 2019, were getting a little bit ahead of themselves in terms of valuation?
Yeah, I do think we will see an uptick. I don't know, again, if it'll be in the first half of next year or after, but you have a lot of dry powder and capital that's been raised from private equity sponsors, and they're in the business of deploying that money. And this year, your corporate clients, the public companies out there, have significant cash on their balance sheets, and they didn't utilize it for M&A. And so I think they're going to find themselves in a position next year of trying to figure out what to do with that cash. May result in dividends or some type of cash distribution to investors, or it may result in them focusing on M&A. And so I do think while we won't see quite the level of activity we saw in 21, we do expect there to be an uptick, certainly kind of in the second half of next year.
All right, appreciate the insight as always, Matt. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.